I'm Alan Kenny, Editorial Director with REIT.com, and we're in New York for REITWeek 2015, NAREIT's Investor Forum. Join me is Stephen Marks, Managing Director with Fitch Ratings. So Stephen, when we spoke at Atlanta 6 months ago, you said you'd had your eye on property fundamentals this year. What are the implications going to be for REITs? What are you seeing?
Fundamentals remain strong, generally throughout all sectors, multifamily, office, industrial, retail. We're generally expecting that there's going to be somewhere between 3 and 4% same-store NOI growth. That's really driven by a couple things. One is that demand remains relatively steady, typically driven by, we look at GDP as a broad economic sort of demand driver, and GDP is kind of bumping along in the very low single digits. We think that creates a good, not great environment for demand, but a good environment. The flip side, of course, is supply. Banks remain pretty cautious still in lending. We are seeing a pickup in some construction lending for new development, but in general, very limited, relatively low limited supply coming online. A couple of markets where we're concerned, for instance, DC multifamily, Seattle multifamily, Houston office, but in general, macro throughout the major markets that REITs tend to focus on, we're not seeing supply being a big issue, and that's in large part driven by limited development.
All right, so all that new development, the new construction, is that being financed prudently?
Big picture, yes. In general, development can be financed really 5 different ways, 3 external, 2 internal. Externally, it can be done via equity, typically companies at the market programs, draws on lines of credit, or debt, and joint ventures. Those are the 3 external sources of capital. Internally, it's retained cash flow and recycling of assets via asset sales. So broadly, companies have been, and we expect companies to access those 5 forms of capital fairly consistently and as their strategies merit. So we think that development will be funded prudently. In general, really 4 out of the 5, as long as you're not funding all your development with debt, we think that companies can develop prudently and in a smart fashion. We are seeing companies, I'd say, doing more asset recycling because of where cap rates are, where valuations are for assets. They're finding that's a more economic way and a less dilutive way for them to finance their development. One thing that we are looking at a little more closely is to the extent that companies are selling fully cash flowing assets and redeploying those proceeds into assets that are still in the construction cycle. Sometimes there can be some hiccups between looking at the metrics because you are giving away kind of full economics on an asset, redeploying that. There's typically a delay in cash flow, but our ratings are long term, they're through the cycle, so we typically adjust for those sorts of things and look at leverage and other metrics on a long term basis.
Next 6 months, what's the big story that you're going to be following?
I think the big story, and it touches on what I was mentioning in terms of how companies are funding themselves via the ATM markets. Our view is that the equity markets, I think, are going to tell a big story in terms of how credit performs, really on 3 different things. One is M&A. Second is how they fund themselves, and third is potentially stock buybacks. We published a report about a month ago saying that the environment is ripe for privatizations. Stock prices are down a little bit in the last couple of months, generally trading below NAV, yet as we mentioned, fundamentals remain strong, so that could be a further incentive for go privates. If fundamentals are strong and stocks are down, companies might be more attractive targets. Talked about stock buybacks. Certainly, like I say, if stocks are trading below NAV, that's certainly a potential for companies to think about buybacks, given that, again, fundamentals are strong, leverage is relatively low across the sector. Does that serve as a catalyst for buybacks? And third is, again, if stocks are trading below NAV, do companies want to use their ATMs or raise equity to fund development or to fund other corporate activities? I think time will tell, because in some cases, some companies' growth expectations are predicated on raising equity. If stocks are trading below NAV, there may be less incentive or less of a desire for companies to suffer a little bit of near-term dilution to grow going forward.
All right, well, thank you so much for your time, Stephen.
Thank you, Alan.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.